The Mexican peso has appreciated 18% against the US dollar over the past 2 years alone. Ford Motor Company closed 2 US production plants. Samsung semiconductor operations expanded in Taylor, Texas, creating 1,800 jobs but sourcing supply chains from Mexico. Tesla announced its gigafactory shift toward border region infrastructure. In the first 6 months of 2024, foreign direct investment in Mexico exceeded $31 billion, a 7% increase year-over-year. Subscribe now as we break down the economic realignment, reshaping North American manufacturing infrastructure. The currency war is asymmetrical, undeclared, and advancing at maximum velocity. When Mexico's central bank, known as Banxico, maintained interest rates at 11.25%, while the Federal Reserve operated at 5.50%, the differential created a carry-trade mechanism of unmatched proportions. Capital flows into Mexican peso-denominated assets accelerated. The Mexican economy performs beyond expectation, and foreign capital seeks higher yields in the southern region. Nearshoring, the deliberate relocation of manufacturing supply chains closer to home markets, transformed from theory into operational doctrine. A Deloitte study confirmed that 62% of American manufacturers are either actively relocating or seriously evaluating production transfers to Mexico. This is not speculation. Foxconn announced construction of a massive facility in Guadalajara, Jalisco, specifically to assemble superchips for NVIDIA's AI infrastructure. Amazon Web Services committed over $5 billion to data center clusters and the numbers demand attention. In 2024, Mexico became the largest supplier of imports to the United States, totaling $466.6 billion and representing 15.6% of all U.S. imports. For perspective, this displaced China, which fell from 21.6% market share to 13.2% over the same time frame. The arithmetic is direct and irreversible. Mexico's manufacturing exports from border states Chihuahua, Coahuila, Nuevo León, Baja California, and Tamaulipas now account for over 50% of the nation's total industrial output. The logistics efficiency is devastating to inland American manufacturing corridors. The arsenal takes form in transport and infrastructure. Container volumes through Texas ports rose 18% annually. Logistics corridors matured along Interstate 37 from Corpus Christi through San Antonio. Mexican trucking capacity expanded to handle outbound volume. The USMCA framework eliminates tariff barriers on 90% of traded goods between North America. Rules of origin stipulate that 75% of automotive components must originate from within the region, meaning Mexican content qualifies. Intellectual property protections strengthen. Labor standards align with U.S. expectations. The legal architecture became a weapon favoring Mexican production. Border manufacturing capacity accelerated simultaneously. Austin, Texas witnessed Samsung's semiconductor plant construction advance toward completion despite supply chain pressures. The facility represents a $16 billion commitment to U.S.-based production, yet raw materials, precision components, and intermediate goods sourced from Mexico comprise 70% of value-added inputs. Mesa, Arizona received Apex Power Conversion's 206,000 square foot headquarters and manufacturing complex, a $60 million investment. Goodyear, Arizona hosted Fluence Energy's battery storage manufacturing facility, part of a $700 million domestic manufacturing investment plan. Waco, Texas, activated Van Trant Transformers, 430,000 square foot advanced manufacturing facility, unlocking $1 billion in annual production capacity. Reconnaissance teams from major corporations conducted field analysis. Texas earned the Governor's Cup Award for the record 13th consecutive year, leading the United States in job-creating relocation and expansion projects. 789 companies relocated their headquarters from California between 2011 and 2021. With departures accelerating after 2017, over 44,400 jobs migrated from California to Texas, specifically between 2010 and 2019. The exodus continues. Realtor.com shifted its headquarters from Santa Clara to Austin. GAF Energy closed its San Jose manufacturing hub and relocated to Texas. The detection phase of this economic operation began when currency analysts at major investment banks identified peso appreciation as an anomaly requiring investigation. The Bank of Mexico reported foreign direct investment in the manufacturing sector grew 18% in 2024, reaching a record $12 billion. This capital influx did not originate from Mexican sources. Investment announcements by foreign corporations totaled $65 billion in the first 9 months of 2024 alone, placing Mexico on trajectory to exceed $175 billion in pledged investment by year's end. Capital flow dashboards lit red across trading floors in New York and Chicago. Intelligence operatives, corporate strategy teams, and supply chain engineers mapped the cost structure differential. Mexican labor rates in manufacturing average $8 to $12 per hour, compared to $18 to $24 per hour in American facilities. Facility construction costs register 30 to 40% lower in Mexican industrial zones. Electricity costs approximated 7 cents per kilowatt-hour in northern Mexico versus 12 cents in Texas. Bandwidth for telecommunications infrastructure costs $4 per megabit in border regions versus $7 inland. The economic gradient favored movement southward. Detection accelerated when tariff policy entered the calculation. Pending U.S. administration proposals threatened 25% tariffs on Mexican imports. Paradoxically, this threat accelerated the reshoring timeline. Companies reconsidered their production footprint. Electronics manufacturers evaluated Arizona and Texas as onshoring destinations, yet the USMCA framework remained unchanged. Mexican origin components entering U.S. manufacturing retained favorable tariff treatment. The strategic response became bifurcated. Move some operations to border states for domestic market protection, maintain high-volume commodity production in Mexico for North American export. Confrontation initiated when U.S.-based manufacturers attempted to resist the structural shift. General Motors delayed new facility investments in Michigan, announcing Arizona expansion instead. Ford consolidated U.S. operations, closing plants in Ohio and Missouri. Toyota evaluated Tennessee capacity in relation to Mexican manufacturing scalability. The company that resisted saw market share erosion. The company that adapted to nearshoring logistics positioned itself for operational advantage. Industrial associations published warnings. Manufacturing advocacy groups demanded policy intervention. The confrontation was economic, not military, but the velocity of market forces generated pressure equivalent to military assault. The clock marked the acceleration phase in late 2023. Banxico maintained restrictive interest rates. Despite inflation moderating, the peso appreciated. By mid-2024, the appreciation exceeded 18% from the prior year. A U.S. manufacturer producing automotive components could either absorb margin erosion through peso appreciation or transfer production to facilities where costs remain denominated in dollars. The second choice dominated strategic calculations. Currency volatility intensified the urgency. A peso trading at 17.5 to the dollar meant that Mexican supplier invoices denominated in pesos cost proportionally more each quarter. A U.S. manufacturer contracted to deliver goods to American customers at fixed dollar prices faced impossible arithmetic. Transfer production to Mexico, lock pricing in dollars for the North American customer base, and the problem dissolved. Alternatively, if the manufacturer possessed subsidiary manufacturing capacity in Mexican soil already, the internal transfer pricing mechanism provided strategic flexibility. The deployment phase proceeded operationally from Q3 2024 through Q1 2025. Caterpillar announced plans to expand Monterrey operations by 22%. Mitsubishi Electronics allocated 30% of new manufacturing investment to Mexico. Qualcomm relocated semiconductor testing operations from Phoenix to Guadalajara. Johnson & Johnson shifted pharmaceutical component manufacturing from Puerto Rico to Monterrey. The announcements arrived with accelerating frequency. Supply chain directors executed the relocation plan with precision. Equipment procurement teams identified manufacturing machinery compatible with Mexican facility infrastructure. Infrastructure engineering teams assessed electrical capacity, water systems, and transportation connectivity in target locations. Human Resources divisions recruited management personnel for Mexican operations and backfilled U.S. vacancies through attrition rather than new hiring. Logistics teams optimized border crossing procedures, reducing dwell time from average 12 hours to 4 hours through pre-clearance protocols. The mechanical process of industrial migration proceeded without announcement. The confrontation with American manufacturing labor markets manifested in employment statistics. The Bureau of Labor Statistics recorded 156,000 manufacturing jobs added in 2024, the slowest pace since 2020. Unemployment among manufacturing workers aged 25 to 34 reached 5.8%. Wage pressure in industrial regions dampened despite labor shortages reported elsewhere. The labor market underwent bifurcation. Edge case, premium employment in automation, robotics, and advanced materials created high-wage positions. Commodity production transferred south. Meanwhile, border states experienced opposing pressures. Texas manufacturing sector activity reached its strongest level in 3 years, during mid-2025. El Paso and San Antonio manufacturing employment grew 5.2% year-over-year. Phoenix metropolitan area manufacturing output expanded 8.7%. The relocating companies established U.S.-based engineering centers, regional headquarters, and management operations in Austin, Dallas, Phoenix, and San Diego. The low-cost production moved south. The strategic and coordination functions moved to border cities. The strategic doctrine became transparent by Q2 2025. American corporations established twin facility architectures, border state operations for final assembly, North American distribution, and engineering functions. Mexican operations for component manufacturing and initial assembly. The Mexican operations served a dual-purpose supply, the North American production base, and exploit favorable USMCA tariff positioning for exports throughout the continent. A component manufactured in Monterrey at $8.50 per unit, shipped to San Antonio for integration into finished goods, carried zero tariff under USMCA rules. The same component manufactured in Ohio at $14 per unit and subjected to transportation costs equivalent to a $2 value add made no mathematical sense. Financial institutions modeled the shift with algorithmic precision. Goldman Sachs projected that 200,000 manufacturing jobs would migrate from U.S. interior regions to border states or Mexico by 2027 if peso appreciation remained above 17.5 against the dollar. Morgan Stanley calculated that manufacturing corporations reducing U.S. labor costs by relocating would generate shareholder value sufficient to overcome relocation expenses within 36 months. Bank of America identified Mexican nearshoring as a secular trend resistant to policy reversal, given structural advantages in labor costs, energy pricing, and USMCA framework benefits. The confrontation evolved into policy domains. Trade representatives requested tariff negotiations, labor organizations demanded tariff protection for domestic manufacturers, political representatives from interior manufacturing regions introduced protectionist legislation. The economic reality proved immovable. A U.S. manufacturer could not compete with Mexican labor rates through political pressure. A peso appreciation benefiting Mexican exporters could not be reversed through tariff threats without destabilizing USMCA framework. The structural forces exceeded policy intervention capacity. Operational impact manifested in specific industrial corridors. The Rust Belt experienced acceleration of existing decline. Ohio manufacturing employment fell 2.1% in 2024. Michigan industrial output stagnated. Pennsylvania facility closures accelerated. Conversely, the supply chain operational hubs in border regions expanded. Logistics parks in San Antonio expanded capacity by 30%. El Paso industrial real estate absorbed 6.2 million square feet of new manufacturing space. Phoenix construction cranes multiplied. Real estate values in border metropolitan areas appreciated at double the national average. The moment of maximum confrontation arrived when traditional manufacturing companies announced simultaneous border relocations. In March 2025, 3 Fortune 500 manufacturers disclosed plans to consolidate operations. Stanley Black & Decker announced transfer of additional production to Monterrey and Chihuahua. Yaco Electronics, a leading electronics manufacturer, opened a 320,000 square foot facility in Juarez. Corning Incorporated announced a Saltillo expansion targeting 30% production increase. The announcements collectively signaled capitulation to economic forces previously resisted. Labor market dynamics revealed the confrontation's human dimension. Manufacturing workers in Ohio, Michigan, and Indiana experienced wage stagnation. Severance packages, early retirement offers, and plant closure notifications arrived in sequence. Communities dependent on single manufacturing facilities faced economic destabilization. Municipal governments confronted shrinking tax bases. School districts reduced staff. The economic realignment imposed real costs on specific geographic regions. Policy responses proved inadequate. Retraining programs reached 15% of displaced workers. Community economic development initiatives stabilized perhaps 30% of affected regions. The intelligence assessments produced by U.S. government agencies during this period remained classified, but available evidence suggests comprehensive understanding of the shift. State Department Trade analyzes documented Mexican competitive advantages. Treasury Department economists modeled currency impacts. Department of Commerce personnel tracked manufacturing relocation announcements. Pentagon procurement officials identified supply chain vulnerabilities created by production shifts. Yet policy responses remained fragmented. No coordinated federal strategy emerged to counteract the economic pressure. Regional initiatives from individual states competed rather than coordinated. Thus, although the accounting of operational results arrived with clarity by Q3 2025. Foreign direct investment in Mexico exceeded $38.41 billion for the calendar year. Exceeding prior records, manufacturing exports from Mexico to the United States surpassed $512 billion, representing 16.8% of total U.S. imports. Border state manufacturing employment reached new historical highs. Texas confirmed its position as the destination for 40% of all major U.S. business relocations. Arizona manufacturing output growth exceeded national averages by 3.1 percentage points. California continued losing manufacturing operations at sustained pace. The Mexican economy expanded at 2.8% in 2024, substantially outperforming previous forecasts. Unemployment fell to 3.2%. Real wages in manufacturing regions grew 1.6% despite labor force expansion. Infrastructure investments accelerated. Port capacity in LR0 CRDENAS expanded. Rail corridors from interior Mexico toward northern border regions modernized. Manufacturing competency increased. Supply chain reliability improved. Mexican manufacturing transitioned from low-cost commodity production toward higher value-add automotive, electronics, and precision manufacturing. The structural realization settled across policy circles. The peso appreciation drove capital investment decisions that no tariff or trade policy could reverse. A peso strong at 17.5 to 18.5 against the dollar created a permanent price signal favoring Mexican location decisions for any manufacturer with discretion over production placement. Currency policy operated above trade policy in the hierarchy of decision drivers. American interest rates, inflation rates, and monetary policy transmitted directly into manufacturing location choices through the currency mechanism. Defense of the remaining U.S. manufacturing base acquired urgency by late 2025. The Biden administration announced advanced manufacturing initiative investments in semiconductor fabrication, electric vehicle battery production, and advanced materials manufacturing. Texas and Arizona received disproportionate allocation of these federal funds, recognizing the concentration of production in border regions. Inflation Reduction Act provisions accelerated. Critical minerals strategic initiative launched. The federal response acknowledged that interior manufacturing required protected status and direct subsidy to survive. The market forces released by peso appreciation proved too powerful for passive policy acceptance. The message emerging from this economic operation is threefold. First, currency appreciation functions as a decisive competitive tool, capable of shifting industrial production across geographic regions independent of trade policy, labor relations, or infrastructure capacity. The Mexican peso's strength operated as an economic weapon system more effective than any tariff or trade restriction the United States deployed. Second, the USMCA framework, despite addressing labor and environmental standards, created structural incentives favoring Mexican production locations that proved immovable through political pressure. Third, the transition from high-wage interior manufacturing to border state operations with Mexican components represents a permanent structural shift, not a cyclical phenomenon subject to reversal. For the United States manufacturing sector, the operational conclusion is stark. Companies that resisted relocation lost market share. Companies that embraced nearshoring secured competitive positioning. The survival doctrine in manufacturing became one of operational flexibility, maintaining design and engineering capacity. In the United States, while leveraging Mexican cost structure and USMCA tariff advantages for commodity production, companies that attempted to maintain full domestic production capability encountered cost structures preventing competitiveness. The alert status remains maximum. The peso appreciates further when Mexican interest rates remain elevated relative to U.S. rates. The interest rate differential between Bank Seco at 11.25% and the Federal Reserve at 5.50% maintains the carry trade mechanism that powers peso appreciation. As long as that differential persists, capital flows into Mexico continue. As long as capital flows continue, currency appreciation sustains. As long as currency appreciation remains, manufacturing location decisions favor Mexico. The feedback loop operates automatically. For manufacturing communities across the interior United States, the operational reality demands acknowledgement. The forces releasing production toward Mexico operate through market mechanisms insulated from political intervention. Border states benefit from location, acquiring both headquarters functions and some manufacturing employment. Interior regions experience disruption. Policy mitigation requires either direct subsidy of domestic production, development of non-substitutable manufacturing capabilities, or acceptance of restructured labor markets. The choice belongs to political leadership, not to market forces that operate independent of policy preference. The final operational assessment, the peso rise eliminated the margin for doubt. 62% of American manufacturers now view Mexico as essential to their competitive positioning. The relocation of 44,400 jobs from California to Texas represents only the leading edge of a larger migration wave. Border state manufacturing expansion will continue as long as peso appreciation persists. Interior manufacturing decline will accelerate without direct intervention. The economic realignment is underway. The transition from mid-20th century high-wage interior manufacturing to 21st century border-centric manufacturing networks is complete. This is not a warning of future developments, but an accounting of present conditions already established. The structural shift is locked in place. Adaptation remains the only viable strategy. Resistance extends only delay. The manufacturing map of North America has been redrawn by forces primarily economic, secondarily political, and substantially permanent.